Welcome back to the show. Let's talk to Mike Ingram. He's a strategist at BGC Partners. Mike, morning to you.
Morning.
Let's talk the Bank of England. You sent two thought-provoking slides over. The first one, Bank of England policy dilemma abating. Is it really abating?
I think it is to some extent. So what I put up on this chart are two surprise indices, which are put together by Citi Group. One is the economic surprise index for the UK, and the line in red is the inflation surprise index.
So purely based on data.
Yeah, I mean, there's a whole range of data, and it's weighted, and they, again, they crunch the numbers so that it's based on historic movements and so on and so forth. So some data is more significant than others. Anyway, so where we went into the spring, into the second quarter, Bank of England was having a bit of a dilemma, and I seem to recall, mentioning this on the show at the time, where you were having the economic surprise indices were falling off a cliff, and you can see that from February. It's only gone in one direction, and since then we know that the economy only grew by 0.2% in the first quarter, probably 0.3% in the second, no better than 0.3% in the current quarter. Okay. So that's down, and by the way, I bet bottom dollar that we're going to see a further downgrade from the Bank of England on its economic forecast when we next see it in November. Anyway, the problem for the Bank of England was, of course, at the same time that the growth numbers weren't looking terribly clever, the inflation numbers were surprising on the upside. So you can see that divergence between that red and that green line. And I've also noted on that line the voting. Yeah, so you see 9-0, 7-1, and then, of course, that 5-3 vote, which shocked many people. So it's now pulled back because actually the last set of inflation numbers behave relatively well. I mean, we had another point in inflation data point yesterday, again, which is probably going to be more dovishly interpreted. So the basic issue there is at least now there isn't that kind of stress, and I think I wouldn't be surprised if that 6-2 vote went to 7-1 and so forth.
Understood. Let's go quickly on to the next slide.
The other thing, however, I would point out is despite the fact that you've got weaker economic numbers, you started to see better behaved inflation numbers. It's still above target, obviously, but the Bank of England has tried to reinforce hawkish rhetoric because, again, and the UK is not alone in this. We're certainly seeing this in the US. The market is basically disbelieving what the central banks are telling them in terms of their intentions for interest rates. So the MPC meeting and the press conference which followed it last week, Team Carney basically said the market is underpricing interest rate risk. What the market do? The market said, yeah, well, do you know what? The numbers say otherwise. You've been all over the shop over the last 4 years. Why on earth should we believe you now? And so I basically noted that, again, despite the hawkish rhetoric, and a lot of it flared up in June as well. You had Mario Draghi, ECB, in Sintra, also sounding relatively hawkish on the ECB side. The Fed was sounding more hawkish, and the UK got a whiff of that. And we saw the implied probability priced in the option market of an interest rate rise this year and subsequent years rise. We've now seen that pretty much retrace, about a 20% chance of a rate rise by the end of this year, and only about a 40% chance of a rate rise by the end of next year. And it seems to me that, particularly the way the numbers are now coming in the Bank of England, they can talk it up all they like, but basically the market's not buying it.
Mike Ingram, brilliant stuff. Great to see you. See you soon. Thank you.